Good morning. This is Ken at Tortoise Capital with a review of the weekend trading reports for May 31st, 2019. So the market is in sideways normal condition on an annual basis using NDX 260. It's at the high end of neutral at 68 out of 100. The 10-day NDX, or the short-term market condition, is at the lowest possible end of oversold at 0 out of 100. In the market mosaic, price with respect to the 200-day moving average is below the 200-day moving average, so we are yellow sideways at minus zero point 0.7. ADX is a bearish trend but with neutral strength at 22.5. The risk index is the 30-period moving average of the VIX divided by the 10-period, and that score is at 0.941, so it's below the 1.0 threshold for risk off. So we're deeply into risk off. Taking that score, 0.941, and comparing it to the last 5,000 trading days, we find the risk Z by computing the average and standard deviation. That gives us a Z score of minus 0.75. And here you see a 90-day histogram of that indicator showing the weakness that has been creeping into the market here lately. And the fact that we were in the spring but then failed back into winter bodes a warning for trouble ahead. The blended monthly rebalancing, you can see what we held through June, what we're going to hold in the month ahead. You see here on the under the current leaders with defensive plays like treasuries and real estate holding sway. In the ETF2 model, the theoretical exposure is at 0 with all 10 of the international indices under their 4-month moving average. So here's a quick look at some of the ETF2 portfolios under the BMR strategy. Only treasuries, Australia, and real estate above their 4-month, everything else on cash. On the 32 ETF portfolio, again, it's all the defensive plays that are working. Gold, short-term bonds, ag, continuing the strength we saw last week. People buying real things. In the Dow 30, only a handful are above their 4-month moving average. Real pain and suffering down here in the former leaders like Nike, Johnson & Johnson, Verizon, and Goldman. Sector spiders all suffering with the exception of the defensive plays, insurance, utilities, real estate, treasuries, and staples. The ETF Max takes a look at the top 50 or so from all around the world and all the different sectors. And again, you're going to see it's overseas and defensive plays like bonds and so forth. ETF2 regional report, everything is below its 4-month moving average, so the allocation model is at 0% invested, 100% cash. The U.S. at 64 has now fallen behind the Euro-Asia leaders at 65, so now it's the world over the U.S. Inside the U.S., it remains tech, large caps, mid caps, small caps. Losses across the board in the S&P sectors, but energy really suffering right now. The alternate asset classes, treasuries, bonds, real estate doing well. Only India and Philippines really exceptional. Also Switzerland. Interesting to see that Brazil and Mexico have now moved ahead of the broad U.S. indices, which are suffering across the board. Only residual strength right now in tech and in the large caps. ETF2 report, again, dominated by the defensive plays. Looking at the daily report for Monday, you see from the 295 to 275, so that's about an 8% sell-off here in 2 legs down and closed poorly. Still deep into the winter, and there was a tiny effort here for spring, but that failed, and now it's still clearly winter. Just about everything auto frames out well. Plenty of 5DDs and 551Ws to choose from. All of these reds in the NDX means that these are all making new time period lows. So 1 month lows, 3 month lows, um, and lots of RSI2 washout patterns as well. So just a nobody wanting to hold that risk over the weekend. Treasuries and gold above their Bollinger Band mean. Gold and Brazil is surprising strength there. You see from the Z-scores how painful this downward move in all the U.S. indices are. Plenty in the auto framer to choose from, and you can see the in the RLFF, the top shelf are the ones that are the most ATR below their own RL270. So these are the deeply discounted value plays. 3M still suffering mightily. 8-to-1 reward to risk ratio in 3M to its 10-day high. That's how bad that's been smashed. These in the red on the bottom shelf are the ones with the most numbers of ATRs above their long-term fair value. So these were formerly the relative strength leaders, but even they're getting taken to the woodshed. These daily squeezes are ones that had a compressed range on Friday compared to their average range, and so breakouts in either direction could really expand, and you can use a daily risk, the other side of Friday's move as your initial execution risk, and still get these favorable reward to risk ratios. S&P, the Qs, 3M, all in that category. Dominated here by the fall and the winter. Nothing is even in the summer, and so these would be the ones that are suffering the most, like Disney, Microsoft, Apple. Painful sell-off, now more than 1 SD below the long-term average. You can see how much has been given off. That's an 8% retracement, and so this is an area where we're looking to see where is that next support level to be found. There's still room for another 4 to 5% sell-off baked into the cake. That's how painful this last 30 days has been, one of the top 10. The 90 has certainly rolled over. The 30 is well outside of that yellow river, as is the 10. So this is a market. So that's one leg down, two legs down. A third leg down could still be down here around 265 at the previous bend of the river. So that's the downside move. And then there are two legs up, once more to 285 and then 295 on the way up. And that's everything we want to cover. Keep your risk measured and your powder dry. This is a stock pickers market, and there's no hurry. And these are also days in which collapsing dragons intraday make the lowest risk moves, lowest risk trades possible. By focusing on the big indices, you'll be in good position there to take advantage of short-term volatility. So that's everything from Tortoise Capital. Keep your risk measured and your powder dry.